Okay, welcome everybody to today's session. My name is Justin Ishac. I'm the Senior Investment Manager here at Sharewise. We have a very interesting topic today to discuss, obviously rate cuts, inflation and opportunity. So thank you everybody for attending today's session. We will be getting right into it. Just thought I'd see if we can wait for others to attend. Maybe I'll give it a minute or two before I kick off. So just bear with me while I just prepare my screen as well. Okay, I think we'll just get into it, and whoever attends, and we'll just get started. So thank you everybody again for attending today's session. Today is the 26th of August, 25. The topic for today is rate cuts, inflation and opportunity, the new Fed Playbook for investors. So I'm just going to share my screen. Perfect. You should be able to see that now, I believe, hopefully. Yeah, lovely. Okay, so I'll just get started with the boring stuff first, get the advice disclaimer out of the way. So this is general advice only. Past performance is not a reliable indicator of future returns. Please seek independent financial advice before investing. The information provided here today is purely for educational purposes. Okay, so I thought I'd again just kick off with a bit of a client example and portfolio performance. So you can see here recently, as of today, client is sitting on approximately $530,000 worth of capital. $160,000 is the total P&L. Total return for the period is 46.1%. You can see we even rode the Trump tariff decline and we're still doing very well, right? You can see the breakdown there too. So obviously, if you're not getting these type of returns, you may need some assistance and really have a think about what you're doing. Today's session is going to really be tackling a lot of the questions most investors have around the recent Jackson Hole symposium, whereby essentially Jerome Powell addressed economic concerns and monetary policy, right? A bit of an opening quote, I think, would be good to kick off today. So the Federal Reserve doesn't just set interest rates, it sets the stage for who wins and who loses in the markets. Today is about turning Fed policy into your playbook, so you're positioned early, not reacting late. Okay, so we're going to go into a few different topics today within that Fed policy framework and essentially the Jackson Hole Symposium and what was discussed and what it means for investors today. So also, I forgot to mention, if anybody has any questions, please pop them in the chat box as always, and I'd be gladly able to answer them at the end of the session. If you'd like a further conversation in detail, I'd be happy to take you through any of your questions at the end of the call as well. I'll be also posting at the end a poll for everybody to answer. So if you could please be very honest, I think it's a very good exercise for you to actually answer the poll at the end, because what it will do is will help you sort of see what areas you can improve on as an investor and what areas you may need some assistance with as well. Okay, so please be sure to answer the poll at the end of the session as well. All right, so today's discussion points. So the first thing is we're going to be discussing the Fed is changing the game, how upcoming rates and sticky inflation are reshaping markets and creating a new playbook for investors. Now, we're going to unpack that. It's not just as it reads, there's a lot more to that. Growth tailwinds, why sectors like AI, quantum computing, energy transition, and tech will be the biggest beneficiaries of a Fed pivot. Okay, so that's also something we're going to really delve into. Income matters as well. So we recognize that investors don't just want growth, they also want good quality income opportunities as well. So we're going to unpack that as well and look at some other areas that we can help you derive quality income through as well. But we're not going to go into the details of the specifics here. So this is all only general. If you do want some more information, you really want to work with me on the advisory side, I'd be happy to take you through a proper strategy session. But this is going to discuss how to protect and grow wealth, high yield opportunities that beat traditional term deposits, even as inflation lingers. The strategy gap. So this is where most investors rely on ETFs or random speculation, but that's not a strategy. You're going to learn how to translate Fed policy today into a real portfolio edge. Act before the markets react, or market reacts. So the real opportunity is in positioning early before the crowd catches on. This webinar will show you how to move ahead of the headlines. And we're going to go into detail on the structured approach that we will be implementing for clients and that we've already been implementing as well. Before we get into that, I just thought I'd share a bit of a slide that I presented in my previous webinar, if any of you attended as well. So in my last session, I actually discussed the Mag 7 and why they are the Mag 7, the sort of footprints and the blueprints of those businesses and how they grew to be the Magnificent Seven. And I also discussed if over 10 years ago, you invested just $10,000 in each of these opportunities, what your portfolio would look like today. In today's session, I thought I'd still reiterate that because in the last session, I don't think I paid enough attention to the importance of investing in the right businesses early on. So before we continue on, I just wanted to delve a little deeper here into this slide to really unpack not only what it means to have invested that much and what your portfolio would look like, but the fact that we're seeing a Fed pivot today means there are so many other magnificent sevens out there that investors should be getting into today, okay? And it's so important to really think about if you're not sitting on any of these businesses in your portfolio today, not ETFs, these stocks, you've clearly done something wrong. I mean, I think that's a fair point, right? If you don't hold a Meta or an Nvidia or an Amazon or a Google or a Tesla or a Microsoft, this is just some of many others, right? What have we really done? So over 10 years ago, $10,000 in Tesla would be valued, as you can see, at over $1.8 million. $10,000. Now, most of you sitting here today probably have well over $250,000 or over 100 grand to invest. And we probably don't even have a single stock in the US market. And if we do, we may have exposure through ETFs. But the evidence has proven that over the last 10 or 15 years, everybody banked on the NASDAQ to dive continuously and to never recover, or the S&P to never recover. In many occasions, time and time again, the market proves everybody wrong. It outperforms during times of strife. Stocks like these run hard and clients miss the run. I mean, the fact is that you can't escape the reality that if we're not investing in these businesses, we're wrong. We're not investing correctly. If we never got in any of these businesses, our methodology is not bulletproof then, right? You know, you may be sitting in your portfolio seeing Rio Tinto or BHP or AGL or some other, let's say, high quality dividend paying stock, and you think you've got a very defensive portfolio, right? Yet BHP's done nothing all year. Rio Tinto's been range bound. AGL's taken about a 15% dive. What's really defensive, right? I mean, I think the majority of investors think defensive assets and portfolios mean you don't get capital growth. You only get some income and you're safe. But I would argue that's not really investing. I mean, I would argue that you're not investing unless you get growth. I mean, what's the point of investing? The point of investing is to get growth, not just sit there and let it, go up and down, up and down, up and down. If you're not getting growth, then what's the point? Well, really, what's the point? So I just wanted to sort of go into more detail around the fact that $10,000 in quality opportunities that are growth oriented is not high risk necessarily, right? We need to really uncover what risk means. And I think there's a really big misconception. And I think investors just need to be educated a bit more around the fact that just because it gives you good growth, it doesn't mean that it's high risk than something like a high dividend paying stock. Because if that's the case, then, well, let's look at it from a bank perspective. Over the last 12 months, CBA has done over 40% return. In that case, it's not safe at all. Right? So let's not, sort of fool ourselves into thinking that we've got the right methodology when really we're just trying to get a bit of a way out of, let's say being proven maybe wrong in a certain way, right? So, and I'm not here to be rude or I'm not here to, offend anybody for any reason at all. I'm just trying to make a point that I think there's a massive misconception, and I think investors need to really understand that we need to sort of view a different style of investing from a different lens, as opposed to just being fixed in what we think is the right thing to do. Because the fact is, these returns speak for themselves. Okay. So Tesla would have been over 1.8 mil, Nvidia would have been over 2.2 mil, Amazon 150, the list goes on. There's so many others anyway, but I mean, I just wanted to make sure that this was seen and, wanted to get a point across here. So Fed signals a potential September rate cut, right? Now, what Jerome Powell said. So Fed signals a potential September rate cut. Powell acknowledged downside risks to employment alongside persistent inflation, but rather than commenting with just data driving the decision, he implied a rate cut unless the data doesn't allow us, from what was mentioned. So suggesting a likelihood of a September rate cut is warranted. And, he didn't commit to it, but markets quickly priced that in on Friday's session. And, I guess we're pricing in now, and what's being priced in is an 85% likelihood of a cut next month. Okay. So that's not definite, but that's probable, is what's been on the table. So there was a cautious and risk-aware tone. So his delivery was notably cautious, acknowledging short-term challenges without, offering sweeping policy shifts. He did emphasize data dependence still in decision-making and provided commentary on broader structural economic concerns as well, like the labour market. Okay, but again, he didn't commit to anything, but he did suggest the potential for, a rate cut on the table for September. Okay, so the next was a lingering, inflation threat from tariffs. So, he warned that there is elevated tariffs at the moment in a tighter immigration policy that evaded or added inflationary pressures and slowed labour market force growth, which complicate the Fed's dual mandate of managing price stability and employment. So, again, he has to comment on these areas, but the reality is we are closer to a Fed pivot than not at the moment, right? So markets reacted swiftly, equities rallied strongly on these remarks. The Dow, S&P and Nasdaq jumped significantly, but also the Russell 2000 as well, okay? So we also saw bond yields fall significantly, and we saw some weakness in the US dollar as well, okay? So there were some political overtones as well from the session on Friday in the Jackson Hole Symposium. So, He didn't address politics directly in his speech, but the broader context included mounting political pressure, especially from President Trump, and concerns around central bank independence. So, he did touch on that point as well. But what does this mean for portfolio growth, right? So there's a few things. So long as, all being equal, the Fed do cut rates, we could see a massive run in the markets continue. But Powell signaled growing downside risk to employment and persistent inflation. He did imply a shift towards a possible September rate cut without committing just yet. The market reaction again was probability of a rate cut has soared to over 85%. Now, in that event, we would capture an asymmetric upside from rate cut tailwinds, which would mean AI and quantum technology, next generation semiconductors, green energy transition, high beta ETFs and stocks. Obviously, allocation would be an important part of the risk management, which would mean that we would consider looking at a diversified, structured approach with weighting as a major part of the general advice, which would mean we might go, as an example, 30% with high risk sort of high beta AI and technology plays, 40% in quality growth and defensive growth, which I'll basically discuss in the next slide, and also defensive, high income, hybrid securities, and other opportunities as well in infrastructure, industrials that will provide a quality yield as well. But the rationale, rate cuts lower discount rates, funding gets cheaper, and liquidity goes for growth and hunts growth. These sectors, AI, next gen, semiconductors, green energy, high beta plays, are mostly levered to this liquidity. Okay, so there is a lot of positives and there is a sound, I would say, argument for further growth in the market. So I've broken down some key ways to really strategize in this playbook, and that would be first and foremost risk management. Okay, so obviously managing risk means that we would look at a structure where we probably look at maybe a 5% allocation in a position that's lower in risk, and then as an example, 10% in another position that's higher. That's 5% in a position that's higher in risk, and then a 10% position for something lower in risk, right? So the higher the allocation, obviously the lower the risk in terms of risk to reward, which I'll discuss further in a one-on-one session as well, okay? But just a generic sort of comment there. Risk management, very important part of our process. Top-down market analysis, so we look at the macroeconomic environment, in this case, rate cuts, which is obviously feeding into monetary policy, which will affect the sector analysis of our choosing, i.e. obviously AI, if rates go lower, and we look at technology. Then we look at the fundamentals of the business, their balance sheet, their market share, their revolution, they're revolutionizing their industry, whatever it may be, right? So there's a lot of things. And then obviously fundamentals and valuations as well. So price to earnings growth, revenue growth, sales growth are all a part of how we measure valuation as well. And then finally, one of our most important, which is overlooked quite a few times for most investors, optimizing our entries and our exits. And the way we do that is through technical analysis. Now, there are people that would say, look, I'm just a fundamentals type person. I don't really care about technicals. But the reality is, if you're not buying at the right time, you're not going to optimize your return. And you can't do that by just being a fundamental investor. Okay. If you've watched my webinars before, I have shown how we identify opportunities using a chart as well. That doesn't mean that we just look at charts and we just say, okay, there's a buy. No, we put that in line with our fundamental view, and then we recommend a trade or an investment based on our entry recommendation and our risk to reward ratio as well, which ties back into risk management. Okay, so exit strategy is just as important because a lot of investors find themselves riding the wave of a bell curve. They buy at the bottom, stock runs like bell curve at the top of the curve, they hold, goes all the way down, and they miss the selling opportunity. I'm sure if you're looking at your portfolio, you've probably had a couple that have done that, right? So we're here to help clients. Now, risk on high beta growth. Just examples here today. This isn't advice to go and buy them today, okay? But I'm just providing a bit of an example so investors get a better understanding of what I mean when I say risk on high beta, okay? So the objective in this would be, if we're buying risk on assets or stocks, we're obviously targeting high beta growth, right? Which would mean that we're trying to buy because we believe the market will run a lot higher. And so therefore, we're taking on more risk because the stock is more volatile, okay? So as an example, AI, quantum technology, some of those names are there. And then semiconductors, leveraged ETFs, or direct names as well in the semiconductor space and green energy. Okay, the transition would be to this sort of green energy would be going in with a lithium play, for example, as well, right? So, and then you've got ETFs that cover the index in different areas, or stock specifics like TSLL, which obviously covers the Tesla stock with a leveraged sort of view. So that's leveraged double the price movement of Tesla underlying shares. And then you've got QQQ, which is for the NASDAQ, PLTU, which is basically a leveraged ETF for Palantir. So the rationale here is rate cuts equal lower discount rates, funding gets cheaper, liquidity hunts growth, and these names would benefit most, right? So now this is just examples again, ladies and gentlemen, please don't go and buy them all today. But I'm happy to go through a strategy session, and obviously with those that become members, we can go through a bit of a strategy and help you unpack the best entry points on some of these names as well. Okay. So rate cuts, inflation, diversified growth, and balanced growth. Now, this objective here would be to diversify away from pure high beta plays, okay, but still participate in the tailwinds that the Fed would provide in a rate cut, right? So healthcare and biotech, companies in gene editing, Tempus AI as an example, CRISPR Therapeutics, ETFs like ARC as well, infrastructure and industrials, they're beneficiaries of the stimulus as well, or CapEx and rate cuts, all of the above. And then technology staples, which I mentioned in the previous slide in the beginning of the session. So Microsoft, Apple, Google, still growth, but less volatility as well. Okay, resources and energy. So Woodside, liquid natural gas, LNG sort of businesses, and obviously BHP, so, right? So this is to hedge, commodity inflation as well. So the reality is we want to take advantage of all the areas that are still a part of green energy, energy in general, and the commodity cycle, right? Because you see, you want to be on both ends of the curve. If we then start to see inflation tick up, well, that would mean that commodities will probably rise as well. And so, businesses exposed to commodities will still do very well over the long term, though, not within the first 6 months, right? This is a very longer term sort of time horizon on that perspective as well. But we can discuss that, throughout the policy shift expectations, month in, month out, quarter in, quarter out, right? So we really need to monitor that. And that's what we do here on the advisory desk as well for our clients. So the rationale, these sectors grow, but also provide a ballast. They smooth volatility when high beta sells off as well. Okay, and that's something you really want to be mindful of. So I guess this leads me into the next slide, where don't miss the best of all worlds, right? So blend growth, income, and defensive strategies. Okay, we shouldn't be fully focused on just growth. We shouldn't be fully focused on just defensive or balanced growth. We shouldn't just be focused on defensive, slow-moving growth either. We should be balanced, right? So at the end of the day, we want to segregate certain balances. So we may go 30% in each sort of area. This should have read defensive, and that's just growth. But anyway, that's all right. So the point is, I think you got the point. You got defensive positions that should be balanced towards 35 or 40%, and then a weighted approach to growth, like your Microsofts, your Googles, and the others, right? Towards a 30 to 35% range. And then you've obviously got high beta names, maybe around 30% as well, right? So we can sort of go through and sort of alter these percentages over time, but the reality is you want to be balanced. You want a percentage in high growth, a percentage in quality growth for the longer term, and then a percentage in defensive strategies as well, like your hybrid securities, your infrastructure plays, and things of that nature. So, I've got a couple of questions that I've been asked, which I'll go through. Thank you for your questions. I think I've addressed some of them anyway, but I'll answer that. Bit of a closing quote as well for everyone. So the Fed has shown its hand. The question is simple. Will you be the one or one of the investors watching from the sidelines or watching the headlines, or one of the investors positioned to profit before they all arrive? Which one are you going to be? Sit on the bench, get on the field. Here at Sharewise, we're going to help you. If you want help, we're more than happy to. Okay? Showing you some client performance. It's not an indicator of future, but at the end of the day, you can see we're doing the right thing. We're getting some good results. So how we help you? Research. We identify emerging trends and companies before they hit the mainstream radar. Shortlist. Only the highest potential opportunities make it to our watch list. Entry timing. We track price and fundamentals to target optimal entry points. Risk management. Every opportunity is sized and structured to protect downside while maximizing the upside. Ongoing guidance. So we monitor positions, send updates, and adjust as the markets evolve as well. Okay. I will answer this question. Okay, so I've been asked here by an attendee, investing to pursue the freedom to whatever one wants, whenever one wants, and with whomever everyone wants. Yeah. So I think the main question there was, you want to invest to achieve some financial freedom and to be able to do as you please and grow your capital to obviously be able to live a nice lifestyle, maybe for retirement, right? And so the reality is that's what we're here to help clients do. Okay, thank you for that. Yes, as well, the session is available in a recording. At the end of the session, it'll be recorded and sent, or it will be uploaded essentially on our YouTube channel. So you're more than welcome to click on our YouTube channel and watch it there as well if you did miss half the session or a quarter of the session. Mining rare earths. Very good question. So I did allude to that earlier on in a part of the transition, right? So we would look at, obviously, as a bit of a high beta play, right? You'd look at some lithium potentially, or clean energy like uranium as well for portfolios. That doesn't mean go and buy them all today, right? But yes, mining rare earths are a very good way of, let's say, exposing yourself to clean energy or transition in energy solutions as well. Okay. So I'm going to launch a poll now, okay, for everybody. So again, ladies and gentlemen, I would highly recommend you do this poll with all honesty, because I think it will really help you sort of uncover where you think you can improve or not, right? So that's on there now. While you do that, I'm going to also discuss why it's important to act now, okay? So when you come on board as a member, we do a one-on-one call to map out our investment strategy. We'll do a strategy session with the onboarding, which means I will look at the blueprint of what we're going to do over the next cycle, right? You'll get exclusive access to the next, let's say, Magnificent Seven as well, or the next best up-and-coming businesses to invest in, okay? You'll also get a discounted price, a significant discount on our 5-year membership. So if you join this week, you'll secure a lower membership cost than normal, right? Limited spots available as well. So we only take on a small number of serious investors at a time because we want every single investor to get, let's say, proper focus, right? We don't want to be bombarded with too many people. So there's only a limited spot left for this monthly take-in. And so I recommend, you do come on board ASAP, right? So you already know what happens if you wait. You've seen the numbers today. This time the choice is yours. Be in early or watch it happen again. Okay. So Justin Ishac, Senior Investment Manager and Head of High Net Wealth Clients. That's my details there. You're more than welcome to reach out. Thank you, everybody, for attending. I think I'll let that run a little more, and I'll just answer another question that I've received from another attendee, which was, Justin, how do you identify the next big run? And don't you think that we've also had a big run already in the market? Shouldn't we consolidate? Really good question. So markets are going to be volatile. We could still consolidate a little bit more, that's for sure. Definitely, that could be still in the cards. But you see, when we look at the overall framework at the moment, the reality is the Fed has signaled a pivot, right? They've signaled that in September they may cut rates. And so if they do that, we could very well see the market move to new highs very quickly. And it could happen sooner than you think. And it could also be not only that, but reach heights that we never even anticipated for the year, right? So, the S&P could break 7,000. And I'm not here to quote specific sort of targets. Please don't take it that way. But the reality is lower interest rates means a lower cost of borrowing and more liquidity. So we want to focus on that as a main framework. All things being equal, if they don't cut rates, that could signal further volatility to the downside as well, depending on the rhetoric from the Federal Reserve. So, there will still be some volatility. There will still be some question marks along the way. But ultimately, from what we've heard from Jerome Powell, they are currently more focused on an average weighted inflation as opposed to a firm fixed inflation target, which means that we're bullish, right? I hope that answers your question. Is there any other questions before I end this poll as well? No? All right, lovely. Well, look, thank you everybody for attending. And all things being equal, hopefully we have a good run in the market. And if not, we're here to help clients monitor the risk. Hope to hear from you soon. I'm looking forward to hopefully speaking to all of you. Thank you for your time and have a wonderful day and happy investing. Thank you.